The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Market angst mixes with market optimism to create a bifurcated trade. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. We're kicking you off to the closing bell right here in the U.S. Happy June, by the way.
Yeah. Is it starting off on a good note?
Yes, not a sell in May and go away just for this last day. But, we're seeing a continuation of what we saw back in May. You're seeing equities okay, with tech really leading the way and tech outperforming continually. You're seeing yields higher, and you're seeing the dollar lower. The Bloomberg Dollar Index now at its lowest level since July of 2023. So steady as she goes, right? Sell the U.S. dollar, sell U.S. bonds, buy equities, Romaine.
Absolutely, and specifically big tech, and that really is the bifurcation we're talking about here. The latest twist, of course, in the trade war was that doubling of steel and aluminum tariffs on Canada, Mexico, and the U.S., fueling a touch of market angst on this Monday. U.S. and China also trading barbs of accusations on their trade dispute. That's not helping matters, nor are the dramatic attacks that we heard about in the Russia-Ukraine war over the weekend. Now, while equities, of course, are taking it in stride, if you want a real look at where the angst is, the agita is, look to commodities. Aluminum contracts right now linked to the prices that manufacturers pay for delivery to the U.S. Midwest, that surged 54%, the highest since 2013. Meanwhile, spot gold jumping more than 2%. That's the 11th time so far this year we've seen a move up or down of that magnitude, and that compares to only 9 times for all of last year. Now, adding to the log pile was fresh ISM data on U.S. manufacturing that reflected widespread uncertainty amid the on again, the off again, the higher again, the lower again rollout of those U.S. tariffs. Factory inventories down, imports of foreign components posting one of the largest monthly slides on record, and supply managers now realizing that for now, there is no efficient way to source their goods and materials.
All right, well, speaking of that, Romaine, let's get to this chart, which shows where we're seeing the issues of tariffs, and it focuses on the commodity market. Now, I realize that the steel and aluminum tariffs are in that market specifically, but now we're having some agita when it comes to copper. So the blue line is the front-month U.S. copper price, and the blue line is the London copper price. And that divergence that we see, Citi says that since we have these aluminum and steel tariffs coming up and doubling to 50%, that raises the possibility that copper will also see some kind of increase with that critical mineral and copper S-232 investigation. Citi says it's been underpriced, and now it continues to be underpriced. So it raises that tariff risk yet again, Romaine.
Absolutely. Let's bring Ian Bremmer into the conversation to kick us off to the close. He's the president and founder of the Eurasia Group and G0 Media. And Ian, I do want to start first with these metals tariffs. Of course, a big announcement made on Friday, and we should point out this all kind of started during the first Trump administration, of course, when he imposed those 25% tariffs on steel, 10% on aluminum. And 7 years later, here we are once again.
Yeah, unclear why people are believing that Trump is touching the hot stove and then going to find more market rationality. It's like, oh, the markets are constrained. I hear it every day from clients. The markets are constrained. They are much less of a constraint on Trump this time around than they were in his first term. He's not running again. He was almost assassinated. He's incredibly confident. He believes that he has all the answers. He shouldn't listen to his advisors. And his advisors aren't willing to tell him when they think that he's doing something wrong. And so it's not the markets don't matter, but they matter a lot less as a constraint on the president this time around. And so, when the judges say, sorry, we're not going to let you use IEPA for your Liberation Day, he's going to find 20 other ways to try to get the outcomes that he wants done. And that means forcing countries around the world to capitulate. It doesn't mean backing off and saying, oh, sorry, I guess I couldn't really do that.
Well, I am curious whether those countries will capitulate. We know that some nations have sort of made overtures, some in earnest, some maybe not so. And I am curious as to whether these nations are going to feel compelled to really come to the table with something substantive, or if they maybe feel compelled to either A, wait this out, or more importantly, Ian, maybe just try to walk away.
Well, I was annoyed at the FT guy that used the term taco trade, the Trump always chickens out. Since, the first country, when I hear taco, the first country I want to make sure it applies to is Mexico. And it's exactly the opposite of what Mexico's done. It's a critical trade partner of the United States. Over 80% of their exports come to the U.S. All their tourism comes to the U.S. Their remittances flow back to Mexico from the U.S. All their drugs go to the United States. I mean, they rely on the U.S. for everything. And as a consequence, they capitulate. That's exactly what they've done. It's what they've done on the border. It's what they've done on fentanyl. It's what they've done on Chinese transshipment of goods. It's even what they're doing for water at a time of drought when their own farmers aren't getting what they need. So, I mean, if the taco trade doesn't apply to Mexico, then, I mean, it explains why they have such bad tacos in the UK, perhaps. More seriously, there are countries around the world that won't capitulate, like China. China recognizes this is going to hurt them more economically than the U.S., but they can handle the pain politically much better than Trump and his democratic system with checks and balances, albeit weakened. And then there are other countries that are going to slow roll a little bit because they'll see maybe I can get a better deal now. Maybe, it's going to be harder now given that the judges are making it more challenging for Trump, that there are all of these deals he wants to get done, but they aren't getting done as quickly as he'd like.
Right.
So, I mean, like so many things out there, it's complicated. And, in the media, we want to say it's black or it's white, that Trump is a coward or he's a predator. And in reality, it really depends on who he's fighting against.
Yeah, and we love our acronyms, so there's also that as well. Ian,
that's true. That's true. And it's a good acronym.
Yeah, it is a really good one.
It really is a good acronym. I mean, it's almost Bricks-worthy in that regard.
Almost. Like maybe we keep that for a while. Nonetheless, though, the result seems to be a change in how America sees itself and puts itself out there on the geopolitical stage, economic stage as well. Does that translate into a sell U.S. exceptionalism, or is that also too black and white?
Oh, we've been selling U.S. exceptionalism for decades now. And by selling it, I don't mean pretending it's working when it's not. I mean that the reality is that other countries around the world are hedging. But hedging U.S. exceptionalism takes a long time. De-risking China is hard, and they're a far less important economy than the U.S. They're not, essential for the world's financial transactions the way the Americans are, and many other things. So, I mean, when you see that American exceptionalism doesn't work for you, you try to find other ways to get things done. And I think that everything we see from Europe now in terms of how much money they're spending on defense compared to the last 30 years, that is the Europeans selling American exceptionalism. But when you watch over the coming weeks, when those same European nations get together with Trump at the NATO summit, you're going to see a lot of the reality that the Europeans are literally a decade or more away from being able to supply their own defense capabilities autonomously, from having their own intelligence autonomously, that they don't rely essentially on the Americans. So the reality is this process is going to be a very, very slow-moving one.
Yeah.
Trump's damage to U.S. exceptionalism is something that our children will face. But, fortunately, as one of the most short-term oriented nations in the world, that doesn't bother us very much. Same thing is true with our deficit, of course.
So I wonder, though, where that will eventually show up the most. Will it show up in a structurally weaker dollar, a structurally higher yields on the back end of the curve, for example?
Not in the near term. I don't see it. Again, I think these things are long term. I think that, you see that when people don't want to come to American universities, that benefits other countries long term. When you see that people that aren't white, that are really talented, and most of the really talented people in the world don't happen to be white, now feel like the U.S. isn't as welcoming to them as it was to my grandma, for example, fleeing Armenian genocide, coming to Ellis Island. Yeah, that's going to hurt you long term. I think there are lots of these things that will matter long term, but in the near term, you got to understand that over the last 2 decades, we have not been heading to a Thucydides trap where China rises and America declines. That's not what's been happening. What's been happening is America's allies have been becoming more asymmetrically reliant on the United States. The power imbalance that's been growing while China has done well has been between the U.S. continuing to do well and its allies being weaker. So it's European productivity coming off. It's the Europeans not building on their defense. It's Japanese and South Korean demographics falling apart. And that didn't just suddenly happen under Trump. That's been happening for decades. So if the fact that America's allies suddenly get it and they're going to start hedging, 3 decades too late. I mean, you're not going to suddenly change your views on bond yields and the U.S. dollar on the basis of that come to Jesus moment.
Absolutely, and it's always important to think about those disparities that still exist. Ian, always a great conversation. Ian Bremmer there is the president and founder of the Eurasia Group, as well as G0 Media. We're going to take a closer look at the market reactions to the developments over the weekend when we come back after the break. This is Bloomberg.
The sell-off in the bond market continues in June. 30-year is up another 6 basis points after as much as a 47 basis point increase at one point in May. Double line leading the charge of a wave of investment firms like TCW and PIMCO that are staying away from the long end of the bond market. Double line's Bill Campbell writing, in other strategies where it's purely long only, we're just basically doing a buyer strike and moving to invest more in that middle part of the curve. Here to give us more insight is Christian Lawrence, head of cross-asset strategy over at Rabobank. You short in the long end.
Yeah, well, I'm certainly not long the long end at the moment. I think the bottom line is having more term premium being built in at this point makes sense, right? There's a lot of uncertainty out there. For me, the big concern, though, is the breakaway from the safe haven status that we're seeing alongside the dollar as well. Seeing those correlations break down over the last couple of months, I think that that's the big concern at this point, because are people still going to be buying US assets? Yes. I think the big concern is, of course, moving out of long durations and into the middle and the front end of the curve. I think that continues. But I think the other point to note is the FX hedging side of things. You know, when you look at the longer holders in Asia, private investors I'm talking about, not official institutions, they are starting to look at FX hedging those positions now. Might not be offloading them per se, but actually hedging that FX risk. And I think that that's a big concern for the dollar going forward.
So how does that translate then into price action? Just like a lot more heaviness in the dollar, like unable to really catch a bottom?
Yeah, that's specifically for the dollar as opposed to the yields.
Sure.
I think when it comes to the yields, I do think another 30 basis points of term premium would make sense. I mean, if you look at term premium for the last few decades, it's been very low compared to historical standards. We are in a world where the fiscal stance is, of course, getting worse, and that isn't going to change anytime soon. Yeah. Everything points in that direction. And there is just, I would say, a loss of faith in US institutions is far too sensationalist. But versus a year ago, are there some concerns about how big a role the dollar is going to play globally? I think that's fair.
Well, that's an interesting point, too, because we made a whole lot of hay on here about the decline of U.S. exceptionals and the rotation out of U.S. assets. And at least when you look at the data, you're certainly not seeing that on the domestic institutional side. Yeah. You are seeing that to a certain extent with foreign investors, but a lot of that is playing out in the FX space. So when you see not just the weakness of the dollar, but the idea of what's at the top of the leaderboard, whether it's the Swedish krona, whether it's the Swiss franc, even the euro, surprise, surprise, is that going to last, or is this just temporary tactical trading?
Well, I've always been a bit of a perma-dollar bull, quite frankly, and I do think we need to put things in perspective. Heading into 2025, everyone was long the dollar, right? This was such a hugely consensus trade. At the same time, everyone was short the euro. Again, another very consensus trade. So such a dramatic repricing, I think, happens when you see positioning so stretched. And the bottom line is, after that meeting with Zelensky, Europe has said that they're going to spend nearly $1 trillion on fiscal expansion. Now, the issue is that a lot of this has been baked into the price over the last couple of months. There's huge implementation risk in Europe. And Europe's coming from a pretty weak position when we think about overall growth, when we think about the health of the German economy, the health of the European consumer. And when you look at equity markets, yes, of course, we've seen a huge switch in terms of the outperformance of Europe versus US recently. But when you look at the structure and you look at some of the top companies in the US, I'm not convinced that this is a trade that continues. I think a lot of that has now happened, and we're going to see a bit more of a rebalancing into US assets over the next couple of months.
And it's a good point, too. I mean, Europe obviously is facing a lot of issues that predate everything that we're going through now. Then when you throw in whatever the heck's going on in Poland right now, whatever's going on in some of these other countries, and the maybe less of a union than maybe what it appears on the surface, how much long-term bets, how deep of a long-term bet can you make on euro strength or on the strength of German bonds or even private assets over there in Europe? I mean, just take public markets out of it.
Yeah, I mean, certainly from my perspective, I wouldn't make those long-term bets.
Okay.
I still think the US is the place to be. Now, granted, there's a lot of uncertainty at the moment. There's a lot of question marks. But I think it's more this repositioning from pretty extreme valuations, essentially, and pretty extreme ratios. I mean, if you look at the performance of, or the ratio between US and European stocks at the end of last year, we were at record levels. So to see this partially unwind makes sense. But is it lasting? I suspect not.
Does that mean that you aggressively sell US, or you just rebalance within it? And if that's the case, is it like a sell Mag 7 by small caps? Is it that?
No, I don't like selling Mag 7 at this point.
So
I
you
think
still like the Mag 7?
I do. You know, when you look at a lot of them aren't as impacted by tariffs as other companies, and when you look at them structurally, these are great world-changing companies. And I suppose my counter-argument would be, how many of those do you see in Europe at the moment?
One. Yeah.
Yeah, exactly.
Yeah. All right, Christian. Great conversation. Great to have you. Kristen Lawrence, head of Gross Asset Strategy over at Rabobank. And we should point out the Mag 7 doing pretty good today. Tesla, Google in the red, but everything else in the green, including a 4% bump for Meta on the day. And we're going to talk about that stock in just a bit. But when we come back, we want to focus in on what's been going on with DraftKings, a big drop in those shares today after the state of Illinois proposed a tax increase on sports betting. We'll discuss when we come back. This is The Close on Bloomberg. All right, time now for our top calls. Big movers on the back of analyst recommendations. And we start off today with Boeing. Bank of America upgrading the plane maker to buy from neutral. The 12-month target on the price lifted to a street high, $260 from $185, with the analysts seeing blue skies ahead as orders for Boeing or aircraft have actually emerged as a favored bargaining chip in those U.S. trade negotiations. That stock right now at its highest level since February. Next up, Nucor, BMO, raising its recommendation on the U.S. steel maker to outperform and modestly increasing the price target to $145. The upgrade comes on the heels of President Trump's announcement that he plans to increase tariffs on steel and aluminum to 50% from 25. At one point, those shares were up 15%, up 10% right now as you head towards the close. And finally, Knight-Swift, Goldman Sachs upgrading to buy from neutral with the price target going up to 65 from 45. The firm sees a favorable valuation and earnings potential for the trucking company going forward. Nevertheless, though, those shares moving lower, largely because of concerns about the uncertainty around tariffs. Another stock that we're keeping an eye on right now is DraftKings. That stock falling about 7% right now as the shares of betting operators are down after Illinois lawmakers proposed a sports betting tax increase in their fiscal 2026 budget. David Katz joins us right now to discuss. He's managing director and equity research analyst over at Jefferies. He's got a buy rating on DraftKings. All right, David, so when we talk about the potential impact of this, I've seen a lot of estimates showing that this tax, when you sort of factor in the existing taxes that are already out there, could sort of take it up to as much as 50%. Is that realistic to you?
Well, look, we've done our math. We've published our math. We're getting about 72 million this year, and that's against a full-year estimate of around 800 million of EBITDA, right? So it's a high single-digit hit this year, probably 80 million or so next year against $1.5 billion current estimate, right? So less impact. I think the important part is that it's a total surprise, right? We had not read or heard, from any of our sources that this might be coming down the pipe. And more importantly, I think investors today are focused on whether this emboldens other states to do it. And in my long tenure of covering gaming, both land-based and digital, we find that certain states behave this way, right? This is what Illinois has done since 2003, right? Because they need to make budgets and they find something to grant. That doesn't mean that other states that are legal are going to do the same thing. We've seen that over the past 12 months since Illinois started this tax increase cycle that we're going through. Most of the states just don't behave that way.
So I am curious what options that DraftKings and the other operations would actually have. So if these tax increases do go through, is that just basically a pass-along cost to the consumer, to the bettor?
Look, I think what operators will talk about with us is, the mitigation efforts of that. This one's a little harder because it's directly on the wagers. rather than a tax on NGR, which is what we saw last year. However, I think dialing in pricing on bets or the odds on bets, I think dialing in the promotional activities that are out there in in an appropriate way. Those are the tools that are available to operators to try and optimize their margins. So they're not without, resources to deal with this. It's not great. There's no getting around it, but they do have some resources.
David, does it change maybe expansion plans or growth plans for these kind of names that are exposed to this?
It doesn't outside of Illinois. It certainly does within the confines of Illinois. Right? I mean, this is still, we keep our eye on the big picture. And this has been a noisy, tough 12 months for DraftKings and for the others in the industry, with some of the tax increases, some of the other endeavors they have in lotteries in Texas and so forth. Bad hold through the football season was particularly tough. But the big picture is that this is a growth market in the United States, right? The TAM has turned out to be much bigger than anybody anticipated. And player values at the state by state level bigger than anybody anticipated. And so that's where we're still focused. It's going to expand elsewhere, but certainly not in Illinois, which has proven itself to be a very business unfriendly state for all things gaming over my career.
Yeah, fair enough. Just not there. So you have a buy rating on DraftKings. What company is kind of best levered to navigate all of the messiness that you're describing?
So also in our coverage is a bit smaller name is Rush Street Interactive. And they are inherently and by design more disciplined and smaller scale. Right? They only are operating sports betting in states where they also have iGaming, which is legal in 6 states in the U.S. And frankly, they've executed superbly well. They also are in Latin America, in a number of states, Colombia being among them, just going live in Peru. And they're very focused on profitability. And their expertise really is the gamification of play, of features and functionality that engage players. And frankly, we meet with them all the time. Investors meet with them all the time. They're very disciplined about what they're doing. And in their case, it's less than $1 million hit in Illinois.
All right. Great perspective, David. Really appreciate that. Thank you so very much. David Katz joining us, Managing Director and Equity Research Analyst over at Jefferies. I'm a Texas Hold'em person.
Are you? I didn't know you were a gambler.
No, I'm not, but I like it.
Oh.
I mean, I'll do it. I'm just not very good at it. My husband's much better at it than me. Do you have a favorite?
I do not gamble.
This is not surprising.
At all, sorry.
Yeah, okay, that's okay. We still like you. All right, coming up, well, not craps. I'm not going to do craps. All right, Andrew Bialecki, there we go. Klaviyo CEO will be joining us next, what he's seeing in the business.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. The same goes, same goes. We have the NASDAQ continuing to lead the way higher, tech outperforming, but overall, not a lot of movement necessarily happening within the broad index level.
Not at all here. On the individual level, yes, but it's still a lot of concerns right now, Alex, about where the heck we are going right now when it comes to trade policy.
Yep, got no idea, unless you're a steel company, and then maybe you have an idea. And that really sets the question for Jobs Friday and what we're going to see from the employment number, and then what that means for the consumer, because all of this uncertainty is going to be roiling consumer spending habits. Now, a company with unique insight on this is Klaviyo, a company that combines marketing automation, analytics, and customer service into one unified solution to help businesses know their customers and grow faster. I'm pleased to say the CEO of Klaviyo joins us now, Andrew Bialecki. I can't do it. It's too hard. Bialecki. I practiced in break and I nailed it. Andrew, sorry. So from your point of view, with your product, it's basically trying to make my life easier as a shopper. How are people like me doing? How's the consumer doing?
Yeah, no worries. We're very excited about the results we're putting up at Klaviyo and how we're helping over 169,000 businesses, like you said, get closer to the consumer, understand who their consumer is, and then build great experiences across marketing, service, analytics, all the core components of CRM. So for your question on how are they doing, I talked to a lot of our customers. I'd say they're cautiously optimistic and very resilient. And one of the things we've been doing at Klaviyo to try to help them out is we've been running weekly pulse surveys with consumers across the US and around the world to understand their buying behaviors. And some of the big insights we've seen is, one, probably predictably, consumers are being a little more thoughtful, with how they're, where their spend is going. But we find a lot of them are reverting back to brands they already know. So we're excited to work with a lot of great brands. We added, the Hershey Company, Belgian, Mattel, some of these brands. And they're going back to these brands. We also find that consumers are a little bit more looking for a discount right now. So the ability to figure out, which consumers maybe need a coupon or something extra, that's making a big difference as well.
Right, I was going to say, how much of it is here's a great experience for the customer versus here's the best deal, and how much it's really being driven by that deal and by that price?
Yeah, it's very much a mix of both. So I'll give you one example. Tatcha, luxury skincare brand, great business. They're using Klaviyo, one, to get to consumers on the channels that they care about. Traditionally businesses would take the approach of, well, I'll have an email strategy or I'll have a social strategy. With Klaviyo, we're bringing all that together. So if you find somebody that prefers to learn about new products through, say, text messaging or mobile or email, you can reach them at the right point in the right time, and then also give them the right content. So in the case of skincare, recommending the right product really makes a big difference. So we're finding that actually can compensate for a lot of the discounting that brands might otherwise have to do. And it definitely drives engagement, because if a brand knows the kinds of products that you're into, they're more likely to come back.
I mean, how effective is this effective more for folks who are already in that ecosystem, meaning that they've already bought the brand's products or at least brought maybe a competitor's products? Is it also effective on people who maybe are new to this altogether?
Yeah, it actually works for both. And this is actually one of the places where we've been able to leverage AI quite a bit. We're able to take, say, you're net new to a business. It's your first time visiting their website, or you're a new subscriber to their, marketing list, or maybe you're reaching out and you have questions, and you're chatting with them. We're actually, through AI, we're able to build models that look at, hey, other customers that look similar, other consumers that look similar, what are their likes and dislikes, and then help make recommendations. And we can embed that across marketing channels, even into the actual customer service experience. And that drives a lot of uplift. So even from a little bit of signal, maybe just from those first couple products somebody looks at, we can actually then cluster and pattern match folks across the entire customer database of that business to help them make better decisions.
I am curious that when we get to a point where we're concerned about economic conditions, we're concerned about consumer spending, I am curious as to whether marketers or whether these brands sort of, I guess, push deeper into this, or they pull back. Is this the type of thing that maybe brands will cut if they do see a material drop in consumer spending overall? I'm just talking about the macroeconomic conditions.
Yeah. Well, at least what we're seeing from our customers is they know their existing consumers, people who have bought in the past that are loyal customers, they're so much more likely to buy again, that they're leaning into technology that can help them deliver, a better experience to those folks. I think actually, we think about Klaviyo as a bit of an all-weather product. When you're growing really fast, you have a lot of new customers, we can help, make their experience great. But maybe when there's a little more uncertainty and you find people are going back to the businesses and brands that they know and love, the more you can show up for them in that moment, the more they're going to value you. Mm-hmm. We also believe that consumers, a lot of marketing now happens through word of mouth. So if you deliver a great experience to one person, they'll talk about it to their friends, and that's obviously a very cheap and efficient way to to grow your business.
All right, Andrew, we have to leave it there. Up against a break. I really appreciate you taking time for us. Andrew Bialecki is the CEO over at Klaviyo. It's kind of interesting to see how fast, Alex, this company has grown. I mean, it was just founded, back in, I think, 2012 or so basically about a dozen years ago. But I am very curious about this idea, and I know investors embrace this company because it's, like I said, there's a sort of a predictable business model to it, but has this company really stood the test of a true downturn in the economy, a true downturn in consumer spending? We don't know if that's going to happen, but if it does, what do these brands do? Right.
Also, the tariff universe is just so radically different than anything we've ever seen before. So having to manage that as well on a customer side would be very difficult. And you shop a lot, I assume, right? So, what? I don't.
Sorry to stereotype, but no, I mean, all seriousness, how do you feel about the ads? Because I shop a lot, and I've noticed a big change in the ads that I get through email, through text, which I would prefer not to get, by the way.
I hear you.
But they have gotten better. I will say that. I felt like a few years ago it was just complete garbage, and now I feel like, oh, this is actually interesting to me.
If it's useful to me, I really like it.
Yeah.
If it's not, I can't stand it. But sometimes it's like, oh, thank you for noticing what I'm looking at, instead of just like putting me to something else that's really random.
Yeah.
I was on Temu the other day, and I was like, don't you guys know what I want? Like, I'm literally Googling this in your website, and they still couldn't get me the right thing. I didn't like that very much.
Temu, big spender.
I know. We're cutting down the budget, man.
All right, we're going to continue focusing in on this space and take it from the lens of advertising. And how about AI advertising? Because Meta's going all in on it. The tech giant making a big bet on automation and marketing. We're going to talk to one of the big players in the ad tech space when we come back after the break. This is The Close on Bloomberg. All right, shares of Meta outperforming, up about 3.5% as the tech giant is making a big bet on automation and advertising. The Wall Street Journal reporting that it's working to enable brands to fully create and target ads using AI by the end of the year. That's according to people familiar with the matter. Let's get some insights on a real person who knows a lot about this. Mark Douglas is the founder and CEO of the newly publicly traded Mountain, the ad tech platform Mountain. All right, Mark. So, I mean, the gist of this article is basically like, okay, I'm a brand. I go to Meta. I say, look, here's my product. Here's my, detergent or whatever. They take that image. They take my budget. They figure out, how to create the imagery, the video, and all that goes into the ad, and then hopefully target it to the right person who's in need of, my, fantastic detergent. Is that generally how this works? And were we not already doing that?
Well, it's how where the market is trending. I think the thing is the marketer, is the brand owner, is the chief marketing officer, whatever that role is, are they going to be at the center of that, or are they going to just hand it off to Meta or Google to do that for them? I think what's going to succeed is keeping them at the center of it. What's kind of being articulated is world in where I guess AI bots will become your marketing team and you just sit back and watch them do your job. And I actually don't think that's going to succeed. I think the brands want to own their messaging, the feeling, the emotion, and that's still going to be a big part of it, even with the automation.
How do you do that, though, Mark? How do you sort of pair those two worlds together?
It's actually very doable. There's a lot of work going into this. Mountain, we're doing work in this area. Obviously, Meta and other companies are doing work in this area, and it's just, when I talk to marketers, they just want help. They want to feel like all of the AI tools essentially give them the effect of a bigger team, but they're not looking to abdicate this to someone else. If they do, then what happens is, every Monday, another company just gives Meta, a marketing budget and says, just create me company. I'm company A. My company is B. Just create me company A. That's not an area where anyone can be differentiated. It's not really where I think brands, how they market now and where they want to go. But they do want the assistance, they want the leverage, and they want to lower their costs.
Well, because you're commoditizing something that wasn't commoditized before. So
exactly.
But is that going to be the future to some extent? And then how do we commoditize something and still differentiate?
I was watching, we have some tools we're working on, and I was watching someone use it, and one person just said generate, and another person kind of said, I want it to be engaging and funny, and they kind of brought their own personality into using AI tools, and you can imagine the difference in the results. So I think hearing Mark Zuckerberg articulate it basically Meta will become your turnkey marketing system and you will play no role in it and you'll just give us money, I don't think is actually how it's going to play out. But there is a lot of automation coming. I mean, a lot. And it's going to substantially lower the cost of marketing products, which is an interesting part of the story. Lower the cost of marketing, you also lower the cost of the product that the consumer is selling. Because a lot of that cost in every product is the marketing cost.
Oh, that's such an interesting point. You can see that on calls, too. The marketing spend is always front and center a lot of the time. Checking in here on the IPO. Your stock's trading at 26. You IPO'd at 16. How do you feel about it? Was this a success for you? Did you leave money on the table?
I think I'm in a quiet period right now, so I'm literally not allowed to talk about the stock. But I'll say I think the market considered it a big success. So I'm not allowed to offer my own opinion, I think, for another 19 days. But I'm happy you asked about it.
Okay, he's like, no thanks, bye-bye. All right, Mark, we appreciate it. Thanks a lot, Mark Douglas, founder and CEO of Mountain. We appreciate that. But hey, I mean, for an IPO when the market was really closed,
Yeah.
$10,
Yeah,
can't be the worst thing in the world.
Yeah, it's not doing bad. I know a lot of people make a lot of hay when you see that big pop in the secondary market.
It's always something.
Okay, yeah, it's always going to be money.
If it doesn't pop enough, it means it wasn't. It's always something
When was
with
the last
IPOs.
time you saw investment bankers get it exactly right on the nose?
But do
That's
we
pretty
want it
rare.
to be exactly right? Did we say we do, but do we?
I'm a perfectionist, yeah.
What? You are?
Yeah.
It's brand new information. No, I'm
Yeah.
kidding. I totally know. Okay, I'm heading out. I'm going to catch a train to D.C., so you have
What?
fun. Yeah,
Oh,
bye.
that is right.
We're about 15 minutes to the closing bell. You get the NASDAQ is up by about 0.6%. The S&P is up 0.3%. Romain will take you through that closing bell with Mo Haghbin, Managing Director of Strategic ETFs with ProShares. This is the close on Bloomberg. Taking a look at other parts of the market here, that bond market, the rally, the sell-off still continues with yields continuing to push higher. That 2-year yield up by 4 basis points, that 10-year yield up by 5, as equities honestly pretty much go nowhere.
All right, we are just about 10 minutes away from the closing bells here. Let's get you the lay of the land with the S&P 500 up about 0.3%. 6 of the 11 S&P sectors are in the green, with the biggest gains, of course, coming from big tech, but also a big boost right now coming from energy. And it is a little bit of a tale of two cities when we talk about what happened over the weekend with regards to the concerns about trade policy, with regards to concerns about the war in Ukraine and some of the other geopolitical events here. You are taking a look there at what we're seeing on the bottom of your screen with General Motors down about 4% here. And we've seen the automakers and a lot of the tariff-exposed companies, particularly those with outsized exposure to Europe, now on the back foot. Not so much concerns about U.S. tariffs, but more importantly, the potential for retaliatory tariffs coming out of the EU. Now, that the third line on your screen, you're taking a look at Omnicom there. We were just talking about the big gains that we're seeing in Meta. A bit of a pullback there. Has some concerns here as we move into a world of more automation in the advertising space and how that might weigh on some of those companies. The VIX is down, but so too is the dollar, and you are seeing yields in the Treasury market up across the board. Let's bring Mo Haghbin into this conversation. He's Managing Director of Strategic ETFs with ProShares, counting us down to these closing bells. We should point out, Mo, we came into this morning, and it looked like we were going to have a sell-off, and we got a nice boost from big tech today. That's given a lift to the NASDAQ and to the S&P to a smaller extent. What you're not seeing is necessarily people embracing small caps, mid caps, cyclical stocks. And I am curious at what do you make of investor sentiment right now when it comes to everything that's going on in Washington, everything that's going around the world, and whether there still is an opportunity to buy?
Sure. Well, thanks for having me on the show again. I think you're absolutely right. Sentiment has been actually skewed a bit more defensive. And when you think about defensive positioning, you should think about the NASDAQ and growth as a bit more defensive, given the underlying companies in that space. So you think about higher quality companies, high return on invested capital, low leverage. These are companies that tend to produce more stable earnings and are resilient to things like tariff uncertainty or supply chain disruption. So we continue to see retail flows being incredibly strong. And, you see ETF flows, for example, being probably on record pace. If you think about last year versus this year, we're trending at record pace. So the retail flows are pretty strong. I will say we're reaching a level of exhaustion, though, and you could see the upside and downside calculus starting to change.
Yeah.
We are starting to see prices for hedging getting a bit more expensive as people think about how to protect the downside.
So when you look at the rally that we had in May, and I think someone said, like, in terms of the month of May, that was the best May that we had in like 35 years or something.
Yes.
But then you look at some of the proprietary data coming out of JP Morgan, Bank of America, and some of the other big brokerages and institutions. That was all retail driven. I mean, the vast majority of it. And I do wonder where the institutional money is, and if that actually creates more upside opportunity if they finally find reason to come off the sideline.
Right. Well, we know there's always the potential for large block trades and assets to move off the sideline. Cash, money market funds, bank deposits are still pretty elevated relative to history. when I speak to asset allocators, it's a really tough time to be an asset allocator. It's a headline-driven market. Yeah. Many of the things we're seeing right now from the administration can move markets very quickly. I think it's important to be nimble, maintain more of a tactical asset allocation posture. But right now, a lot of institutions are actually taking very little risk versus their policy benchmarks. If I had to say one area that I've seen quite often is a little bit underweight equities in favor of fixed income, but in the belly of the curve, not necessarily in the long end.
Well, we've been talking a lot about that on the show, this idea of, I guess, in theory, a buyer strike on the long end of the curve. And you have Double Line and a few others making it very clear they just don't find the term premium that you're getting out there attractive at this point. If everyone's crowded, though, into the shorter end of the curve or even into the belly of the curve, does that create, in your view, any sort of potential market risk? The idea that if everybody's on one side of the seesaw, so to speak, and things go wrong, then what's the catastrophe if everyone tries to go to the other side?
Well, I think about everything relative to the benchmark. So if you're a 60-40 investor, how do you maintain your duration profile versus that benchmark? Many of the clients I speak to today are hugging that benchmark. They're not really looking to take duration risk. And it's always been difficult to make money in rates. Rates and FX historically have been difficult areas to drive alpha. And right now, I'd argue, even harder. So for now, I would say maintaining that policy benchmark tracking error to a level that's comfortable is what we're seeing from the institutional space.
What about inflation risk right now? And I know that's still a question mark when it comes to trade policy, but are you seeing people sort of take those types of hedges out, whether it's through ETFs or even more directly through TIPS?
I think it's the other way around. I think there is an element of uncertainty that is built into portfolios and how do you position for what could come, right? So inflation is tame. Like if you look at the numbers, we're seeing pretty little concern, but it's not about current inflation, it's about expected inflation or forward inflation. And if these trade wars and things that are happening around trade start to go the other way, I think we've had a lot of positive news. At least more recently, there has been at least a attempt to resolve some of these issues. If that goes the other way, I think that inflation surprise could come back into the market.
There's a risk right now, though, that we could end up in this sort of range-bound market. We've had a nice rebound. We're back to 5,900 on the S&P. But to make the case for getting the S&P back to 6,100 or even beyond, at least in the next 6 to 9 months or so, that's going to be predicated not just so much on a tamp down in Washington, economic conditions, but for corporations to really deliver on the earnings side. And I know they kind of delivered this past quarter, but the guidance they gave going forward certainly didn't seem like there was a huge light at the end of the tunnel.
Right, and it's a mixed bag, right? I think what we're seeing in the tech sector and the higher quality companies is a year-over-year growth number that's really impressive. That's not uniform across the board. So to your early comments, we see higher quality companies both in the mid-cap and large-cap space as more attractive than low profitability or small-cap companies. Again, that uncertainty is hanging over the whole market. And what are the companies that are going to be resilient? What are the companies that are going to deliver? Those earnings numbers are going to matter, and fundamentals will eventually matter again, right? So thinking about that allocation to those higher quality companies in this market, I think, is very prudent.
Just real quickly, like of all the products you guys have over there, I mean, where are you seeing the most activity and most buying?
Sure, so infrastructure has actually been an interesting conversation. Real assets has been one area that we've seen a lot of interest. If you think about inflation, if there's inflation surprises and growth is low or stable at kind of 2.5%, those assets tend to do well. The other, as I mentioned, dividend-paying stocks have been an area that we've seen a lot of interest in, especially in the mid-cap space.
All right, Mo, great conversation. Mo Haghbin is the Managing Director of Strategic ETFs with ProShares, helping us count you down to the closing bells here on this Monday afternoon. Just about 2 minutes until we get there. The S&P holding on to its gains, up about 0.3%. Steel companies, gold companies leading the charge on a percentage basis. To the downside, solar and automakers. A full breakdown starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet Fu, taking you through to the closing bell, a global simulcast. It starts right now. Alex Seal off on assignment. Carol Masser has the day off. Emily Grafeo filling in for her. And, of course, Tim Stenovic joining us, as always, as we welcome our audiences across all of our Bloomberg platforms, television, radio, and our partnership with you too, Tim. A bit of a bifurcated trade here. Big gains in the NASDAQ on the day, but you're still seeing the Russell, the transports, and the mid-caps basically straddling in the line between gains and losses.
Yeah, and it's kind of like not really what we saw earlier in the session. We saw stocks were really doing nothing earlier. They got a little bit of a bounce just in the last couple of hours, and we've been hovering around this area. I don't know. Maybe they're thinking about investors are thinking about the economic data that we got today that we'll get later this week. Broadcom earnings after the bell later this week. Not too many catalysts in the near term, I think, that are kind of moving markets right now.
But if you're a cross-asset reporter, it was an exciting day across asset classes. You look at the move in long-term treasuries, oil moving higher, Bitcoin is lower, which you wouldn't expect that on a risk-on day. So under the hood, the cross-asset is interesting.
And don't forget the U.S. dollar near a 2-year low as well. I mean, this could all change later on this week if President Trump and Chinese President Xi Jinping end up having their conversation that we've been teased on for so many days now.
Yeah, I mean, what's that conversation going to look like, though? Because at this point, I'm so confused as to exactly what either country wants. I think I have a sense here of what President of the United States wants, but I'm not really clear how that dovetails with what the Chinese government, at least what they've communicated publicly. All right, we get the closing bells here in New York. Let's take a quick look here. With the Dow Jones Industrial Average relatively unchanged on the day, as it takes a while for these numbers to settle. Seeing EW Scripps actually ringing the bell there on the NASDAQ. And look at that, over at the NYSE Grinder ringing the bell there in honor of the start of Pride Month here in the U.S. The S&P 500 higher by 24 points, or about 0.4%. The NASDAQ up about 0.7% on the day, and the Russell 2000 clinging to gains higher by 4 points, or 0.2%.
Kind of evenly split between gainers and decliners in the S&P 500. 241 stocks moved higher, 261 to the downside.
Yeah, you look at the sector performances, and there's a lot of green here on the IMAP. The only sector to finish in the red is industrials, losing about 0.25%. Healthcare and REITs were basically unchanged on the day, although they did tick into the green at the close, with the S&P 500 ending at its session highs. Energy, the best performer here, as crude oil, as Emily mentioned earlier, getting a big bid. And tech and communication services all gaining as well.
All right, let's take a look at some of the gainers on this day today. Applied Digital up more than 48%. It's a digital infrastructure company, i.e. cloud services for high-performance computing. Shares surged, and get this, it was only the biggest jump going back to September. This after the company entered into 2 lease agreements with CoreWeave in North Dakota. Remember, CoreWeave is the cloud services company. So under these agreements, Applied Digital will deliver 250 megawatts of critical IT load to host CoreWeave's AI and high-performance computing infrastructure at its North Dakota Center campus. Also, keep an eye on what happened with steel and aluminum stocks today. A host of these companies moved higher. I picked out in particular Steel Dynamics, higher by 10% today. This after President Trump said he would be increasing tariffs on steel and aluminum by 50% from 25%. The president did say on Friday that the move would help protect American workers. This was as he visited a U.S. steel plant earlier late last week, I should say. The president also said he would raise aluminum rates in a post on Truth Social. That post said the new rates would become effective this coming Wednesday.
Why did you choose Steel Dynamics and not the others, Tim?
Steel Dynamics was the best performer when I looked in the S&P 500 on a percentage basis.
Oh, okay.
Yeah, so in the S&P 500.
There's a method to his madness.
Okay.
Yeah, there is a method. It was actually a hard decision. I, in fact, even looked at some steel ETFs if I wanted to do one of those.
Ooh. Yeah.
But it was only moving higher by like 2.5%, 3%. I thought this was a more dramatic move. So.
All right. Well, Cleveland Cliffs up 23% on the day.
That was the
best
one.
Day since 2016.
But that's not in the S&P 500.
How's that for a superlative?
It's not in the S&P 500.
Oh my gosh.
And the market cap is only a fraction
of
what Steel Dynamics is. So, yeah, there is a method to this madness.
He's got big cap bias.
Hey, there is a little merger action happening. M&A Monday, Blueprint Medicines Corporation, higher today, just surging 26%. Sanofi agreeing to buy the company for at least $9.1 billion. Sanofi is looking to further expand its rare immunological disease portfolio. The company plans to finance the transaction with a combination of cash on hand and proceeds from new debt.
All right, and looking at the decliners right now, DraftKings falling as much as 8.5%. but it actually ended the day down 6% after Illinois lawmakers proposed a sports betting tax increase in the fiscal 2026 budget. Flutter Entertainment was also lower, but the DraftKings drop perhaps more significant here. This was a surprise move from Illinois following last year's unexpected boost. According to analysts at Truist and Oppenheimer, they say that online sports betting operators will have to pay a 25-cent fine on the first 20 million wagers accepted, and then a 50-cent charge thereafter. I'm also looking at shares.
I just want to say, too, we caught up with David Katz at Jefferies, because I was kind of confused as to why the shares are reacting so much. And he said the bigger issue here was that if Illinois does this, then it gives sort of a green light for other states to follow suit, and that would be the real risk. That's his view, not mine.
Right, yeah. I feel like we typically see those fears of like a contagion effect when it comes to anything around sports betting proposals like this one. But now flipping back to Tesla, shares dropped as much as 3.8%, finished the day down 1%. A French industry association said today that Tesla sales plunged 67% to an almost 3-year low in France. And this is undercutting CEO Elon Musk's assertion last month that the car maker has recovered from its early year sales slump. And then finally, advertising agencies fell. Interpublic Group is one of them. The Wall Street Journal reported that Meta is planning to enable brands to fully create and also target ads using AI by the end of next year. And we saw this company, $8.4 billion market cap. It's an organization of ad agencies, finishing the day down 4.5%.
All right. Just real quickly, speaking of trade, we are getting some headlines here out of the border, Customs and Border Administration here in the United States saying that they have extended the pause on U.S. tariffs on some Chinese goods to August 31st. And of course, there's been a lot of chatter today about more high-level talks between the U.S. and China in resolving this trade dispute here. And of course, it's hard to keep track of exactly which goods and which tariffs this actually applies to. But the headline here is that it has extended the tariff pause on some Chinese goods until August 31st. Let's take a quick look at yields. They did finish up across the board and across the curve here by about 4 basis points, almost evenly. You're taking a look at that 2-year yield, still holding just below that 4% level, your 10-year yield at 4.4, and your 30-year yield right now at about 4.9.
Hey, one of the stories that caught our attention today has to do with everything that's happening at Newark Airport. I know a lot of people in the Northeast are focused on this.
Is there anything happening at Newark Airport?
There is. They actually finished a runway ahead of schedule.
Ahead of schedule?
I know. It's pretty wild. They finished a runway ahead of schedule, and now they're set to actually increase flights later this month. This follows the completion of construction at one of the busiest hub's runways. This, according to the FAA earlier today. The FAA also saying it's going to allow 34 hourly arrivals once it certifies the recently rebuilt runway. It's now limited to a maximum of 28 per hour under restrictions imposed by the FAA to reduce delays. That compares to the typical maximum capacity of roughly 38 landings each hour.
So this increased capacity, it's expected to alleviate congestion and delays at the airport. We'll have to hold them to this. It's interesting because even if the flights are going to increase, will the demand increase? The New York area has a number of different airports that consumers can typically choose from. So it's interesting.
What's your favorite airport, Emily?
What's my favorite?
Yeah.
LaGuardia. But obviously, I mean, you can't fly international, but I love LaGuardia.
Yeah, well, no one can.
Unless you want to go to Montreal. I think there's some nice Montreal flights from LaGuardia.
But you can't go to California, for instance, Tim. When you want to go home, like that's not a possibility.
It's JFK or Newark. And I was a Newark person until a few weeks ago when I switched all my travel for the summer over to JFK because of the issues that Newark has faced. This is a huge issue for United Airlines, of course, which has one of its busiest hubs at Newark Airport.
Although it has that partnership now with JetBlue, so that does give it more of a, I guess, presence at JFK.
Not overnight, right?
Not overnight.
When they do get those slots at JFK, and then JetBlue gets some spots at Newark. We'll see.
Yeah. Okay, so good. That's good. Things kind of returning to normal at Newark, and maybe the IPO market is returning to normal as well. One can hope. Circle Internet Group, as well as its shareholders, increasing the size and price of its IPO. So that, of course, signals perhaps strong demand for the stock. This is the stablecoin issuer. They're now offering 32 million shares between $27 to $28 a pop. That's according to a filing with the SEC.
Yeah, I mean, this is interesting. I mean, we've actually had a lot of IPO activity over the last couple of weeks, and I was actually curious when we were talking about, I can't remember if it was the Mountain or the eToro one, and someone was showing the data about the number of IPOs so far this year, at least through the month of May, higher than last year, over the same stretch of period, and the number of companies going public has been higher as well. You would kind of not think that given all the chaos.
Well, I think what's so interesting is there was this pullback right after the so-called Liberation Day and when markets were in chaos and leading into that. And then as we've seen this steady drumbeat higher, more than 20% from those lows on April 8th, we've seen some of those companies dip back into the markets, and we've seen a stability come back, and we'll see what happens throughout the summer. But it does look like at least some big news coming from when it comes to those tariffs on some Chinese goods coming into the U.S. We'll get more details on that headline on both of our programs. That is going to do it for our cross-platform coverage of the close. It is the closing bell. You guys are going to do your thing on TV. We're going to do our thing on radio, YouTube, and originals, but we'll see you tomorrow, same time, same place.
And we continue our coverage right here on Bloomberg Television. A big week for economic data here in the U.S., including that big jobs report on Friday. A breakdown with Francis Donald over at RBC. That's coming up next here on The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick, coming off what was an incredibly strong May. A little bit of a mixed start here to the month of June. It looked like it was going to be a lot worse at the start of the session, but stocks did get a little bit of traction as we got closer to the bells. The S&P 500 finishing higher by about 0.4%, about a 6 to 0.7% gain for the NASDAQ indices on the day. We did see yields creep higher across the yield curve on the day here, but there are two big stories that to keep an eye on, and they're both in the metal space. With regards to precious metals, spot gold, 2.75%. We should point out, you do not see moves like this on a normal basis. We've had 11 days just this year alone where we've seen a move of 2% or more up or down for spot gold. That only happened 9 times in all of last year. A lot of that, of course, has to do with that bid for Haghbin because of the uncertainty around tariffs. And speaking of tariffs, you also saw a big pop today in when it comes to the industrial metals, Scarlett, because of, well, some new tariffs, some additional tariffs, I should say, on steel and aluminum.
That's right, that the president announced last week. All right, let's take a look at some of the names that are moving on those tariffs announcements. Steel Dynamics up about 10% on the day. Nucor also gaining today along with Cleveland-Cliffs. As for Steel Dynamics and Nucor, which are bigger cap, they rose the most in 2 months. President Trump doubling the tariffs on steel and aluminum imports to 50%. They are scheduled to go into effect on Wednesday, which also means there's plenty of time for it to perhaps change as well, given what we know about how this is kind of unfolding. Blueprint Medicines up about 26% on the day. This is after the company is being acquired by Sanofi for $129 a share in cash. That's equivalent to about a 27% premium to Blueprint's last close. And CDW down about 3%. It's an example of an IT company that is reliant on government contracts. According to the Wall Street Journal, the White House is targeting tech companies as it looks to cut more federal contracts. So we're seeing declines in names like CDW, like Booz Allen Hamilton, as well as Leidos. We'll keep an eye on those developments. Now, our top story this hour is how will the constant on-off tariffs show up in this week's economic data. We got an early glimpse in a pair of surveys tracking manufacturing activity, and they showed a pullback in activity as well as a plunge in imports to a 16-year low. That's a stark contrast to earlier this year when some companies were importing more to get ahead of tariffs. In coming days, of course, we're going to get a read on the services industry, which is a much bigger part of the U.S. economy, along with a steady drumbeat of jobs data leading up to the government's big monthly employment report on Friday. Romaine?
Well, speaking of employment, some headlines crossing on Uber. They have a new COO, Andrew McDonald, who basically run the mobility business, being promoted to CEO. And this is the first chief operating office role at that company since 2019. We're going to get you some more details on that in just a minute. We should also point out that the CEO of the company, Dara Khosrowshahi, says he's, quote, not going anywhere. We're going to get you some more details on that and bring you an update as soon as we can. But we do want to refocus back on the broader U.S. economy here, and particularly the labor market with that big jobs report coming up this Friday that Scarlett just talked about. Francis Donald joins us right now, Senior Vice President and Chief Economist at RBC. And let's start off with Friday's numbers here. I mean, we're not really expecting any material surprises here, but I am curious about what the long-term trend has told you, Francis, about the health of the labor market.
Oh, it's a good question to focus on the long term, in part because we're still getting material distortions in the short term in April data and likely also May. Our focus in a lot of this jobs data moving forward is the structural trends of mass retirees and a significantly aging population. Now, that typically remains a structural story that shows up 5 years, 10 years later in a forecast, but we know it's impacting things right now. For example, we're expecting about 160,000 jobs to land this Friday, but half will be in healthcare. So parsing out the structural trends from the cyclical ones will be really clutch. And at the end of the day, we stand by this story, which is America needs workers, not jobs. And this labor market will remain very tight off of supply issues over demand.
Well, that's what I'm curious. Where are those workers coming from, Francis? I mean, is the supply, first of all, of homegrown, native-born Americans going to be enough? And I'd be remiss in not pointing out the crackdown that we've had on immigration, illegal immigration, to be fair, but of course that has ramifications for legal immigration too.
We'll pivot back to just the actual native-born population. The United States has the largest share of those over the age of 65 it has ever had. Over 1 in 5 Americans over the age of 65. And while labor force participation rate seems low for the total economy, it's down near 63%. If you look at those prime age workers, those 18 to 54, that's near record high labor force participation rates at 84%. So every year that goes by, we're seeing more retirees in the United States than they were the year before. That's going to make the employer's job really complicated. It also messes with a slew of our data. For example, if you retire, you don't go into jobless claims, and employers are going to realize if they replace an employee that's retiring with a new hire, that actually doesn't flow into non-farm payrolls. It counts as a zero-sum game. So recognizing just how important these structural trends is and this retirement trend is, it matters now on a month-to-month basis. We can no longer think of demographics as being this long-term structural story alone.
Yeah, that's a really important point, especially as we focus so much on that monthly number. Speaking of the monthly number, at least on the headline, I'm looking at estimates, and they range anywhere from 75,000 to 190,000, with the consensus estimate at about 130,000. Are we going to get a sub 100,000 non-farm payrolls number this month?
Well, that's not our call, but at this point, every economist will tell you the range of outcomes is extraordinarily large, and that's because we're having a very difficult time understanding how this concept of uncertainty will weigh on the economy. Well, if you look at the hard data, especially in April, honestly, when I look at April data, apart from the trade data, you would not be able to convince me if I hadn't seen the news that there was a trade war going on at all. It was a very resilient April economy. But that massive drop that we've seen in sentiment indices, we're still trying to get a sense of how that's going to change behavior. And Scarlett, we just don't have historical playbooks for this huge amount of uncertainty that's weighing on the economy. We see it in things like the ISM data. There was one comment in there today that the administration tariffs was creating supply chain disruptions that rivaled COVID-19. We're looking for any sort of clues that give us a sense of that uncertainty, soft data, hard data side, but we just don't know as economists, and so the range of outcomes is very large. We're scenario analysis over point forecasts right now. That's the name of the game.
You know, as you mentioned, the on-off tariffs are starting to show up, of course, in the soft data, and in some instances, in some of the hard data as well. I think about the second read of first quarter GDP, and that definitely showed up there. Is it safe to say that once it starts showing up, that we're going to start seeing all the hard data reflect the tariff uncertainty?
I don't know how much hard data we're going to see this in. We are anticipating a slowdown over the course of 2025, but Q2 is tracking pretty well. And of course, we're still in massive distortions of front loading and then having too much of an inventory build coming off. But critically behind the surface here in this soft data to hard data story is a theme we've seen for the past several years, which is soft data like consumer confidence is probably oversampling low and middle income households. Those top 10% of Americans are spending 50% of all of the money in the system. So if you want to have a sense of how the consumer in aggregate or the whole economy is going, you really have to bias your analysis much more towards that wealthy American consumer. And that's why we're keeping a very close eye on accommodations, hotels, airlines, discretionary spend as being a better or more helpful indicator than maybe it was even 10 years ago.
Got it. Francis, always appreciate your joining us. Francis Donald is Senior VP and Chief Economist over at RBC. Now, coming up on the close, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is the close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Mark Maron, turning off his podcast mic. The host of WTF with Mark Maron is ending his run after 15 plus years.
Yeah, I mean, this guy basically kind of pioneered this kind of format. I mean, we go back to sort of the old days when he was broadcasting from that, little, tiny garage that he had out there in California. And he really came to my attention, of course, when he had that interview with the president of the United States, Barack Obama.
Yep.
And everybody like, why is the president of the United States, a leader of the free world, going to some guy's, garage in, Fresno or wherever the hell he was?
Participating in a podcast. But he really kicked off that golden age of podcasts, right? Where all these guys get paid a lot of money. But he's hanging it up and going out on a high.
Well, speaking of the golden age, Jonathan Anderson is now joining the luxury brand Christian Dior, naming him as the sole creative director across their men's, women's, and their couture brands. We should point out that he previously was at a brand that just up until about 2 seconds ago I thought was called Loewe. Loewe.
Yes.
So I'm not as cultured as I thought I was.
I had to get schooled on how to pronounce it. But before that, he was creative director of Loewe. And Dior, he has his work cut out for him because it's been underperforming all the other LVMH brands in the portfolio.
Yeah. Absolutely.
All right, let's take a look at the last person on our list. Jamie Dimon, the longtime JP Morgan Chase CEO, says his retirement is several years away, but the decision is up to the bank's board. Of course, Romain, the 69-year-old Jamie Dimon is chairman of the board, so it's not like he doesn't have a big say here.
Sigh. All right, Jamie's going to do what Jamie's going to do,
Exactly.
and of course he's earned it. So we'll see. One day he will step away, but according to him, not for several years. Speaking of changes, though, in the C-suite, we do want to say on that topic, particularly when it comes to the CFOs, a lot of shakeups there, particularly as turnover hit a record in the first quarter. Nina Trentman is senior editor at Bloomberg Editorial, who covers this, and I guess I'm not surprised. I mean, it's been a tough job, but what are the numbers telling us?
Yeah, it's a tough job. That's fair.
Mm-hmm.
The numbers certainly show us that there's an increase in turnover. Not a surprise if we're thinking about what happened this year. So I'm referring to the first quarter, which is the only period for which we have data.
Yeah.
So we have 95 CFO changes at global companies around the world, which is up from 89, which was a prior year record. And of course, is a testimony to the fact that the job is really hard, and it just got much harder with Trump
and there's no way
doing what he's doing.
Yeah, and there's no way to know if those people voluntarily left or if they were kind of, nudged out.
Yeah, there's always a mixture of wordings that you see in filings.
Spend time with the family.
Retiring,
blah, blah, blah,
then also
all the code.
Moving on, new opportunities. And of course, with some people, you see them landing elsewhere, but also in other cases, you know that they would have just been gotten the boot.
So with all this CFO shuffle, which kinds of CFOs are the most valuable, the ones most in demand right now?
What I'm hearing from recruiters is certainly that people are saying experience and more experience is what people want to see, specifically because right now, of course, it's not as if anybody can claim that we've seen this before, because for all of us, this is new, and what we're seeing in recent headlines and what Trump is doing is new. But I think what people want to see is some kind of experience of having navigated prior crises, prior sudden changes. So, for example, during COVID. So what I'm certainly hearing from CFOs is that they're saying, and also from recruiters, this is not the time for first-time CFOs.
I don't want to put you on the spot, but I do want to just go back to some breaking news that we had a little while ago involving Uber, elevating the guy who ran their mobility business to the title of COO. And it's kind of two things I found interesting about it. They haven't had a COO since 2019. And I am curious about the reshuffling that we see at the top isn't just about, of course, filling slots, but it's also about the CEO and, more importantly, the board making a decision about what's most important. So we talk about the importance of, obviously, a CFO's importance, but these roles and how they're changing and what they're supposed to be doing. What are you seeing there?
We're certainly seeing that more CFOs are taking on COO responsibilities as well. So in addition to those very straightforward COO appointments where companies oftentimes might not have had one for a long time, we're seeing also that CFOs are taking on the additional responsibility, for example, at Salesforce and also at other companies where basically companies are merging roles and giving somebody a really big beat. Interestingly enough, if we look at CEO succession, then the people who most often succeed the CEO come from the COO position. So it's certainly maybe an indication for that. I don't know if I have any inside knowledge there, but...
Well, we should point out the story says Dara Khosrowshahi says he's not going anywhere. So,
well, that's what they all say, right? That's the code that goes along with everything. All right, Nina, always appreciate it. Thank you so much. Bloomberg's Nina Trentman. And don't forget to sign up for Bloomberg's CFO Briefing. This is a weekly newsletter for and about CFOs featuring top executives at global companies and covering key trends in corporate finance by our very own Nina Trentman.
Look at that portrait. I got to get somebody to redo my shot. That is great,
yeah,
by the way.
It's high end.
All right, when we come back, we're going to take a closer look at what's been going on in the world of trade, what's been going on in the world of steel trade. I know you were probably shocked by that big announcement on Friday, right?
It kind of came from nowhere. No one expected it.
Yeah, well, it's kind of interesting, too. It might be a little bit of deja vu all over again. When we come back, we're going to take a look back in history to the origin of these steel tariffs, which, believe it or not, weren't that long ago. This is The Close on Bloomberg. All right, so we know now, President Donald Trump on Friday threw another grenade in the sprawling trade war with the world. This time the target, steel and aluminum, a vow to boost tariffs on the metals to 50% from 2025. 25%, excuse me. Futures tracking the prices that U.S. manufacturers actually have to pay for that surged today, up more than 50%. But we've actually been here before. In fact, exactly 7 years ago, on this day in history, that was when the Group of 7 finance chiefs meeting in Whistler, Canada, issued a rare rebuke of a member nation, claiming that U.S. trade tariffs at the time would undermine global economic confidence. That rebuke, made on June 2nd, 2018, came just days after U.S. Commerce Secretary Wilbur Ross announced new duties of 10% on aluminum and 25% on steel shipped from Canada, the EU, and Mexico. Canadian producers of everything from oil to farm equipment sent reeling, and Canadian Finance Minister Bill Morneau, well, he went seething, issuing a blistering summary of an acrimonious 3 days of talks with then U.S. Treasury Secretary Steven Mnuchin. A week later, as is customary after the finance ministers meet, the heads of state of the G7 gathered, and things were no less tense. The summit saw the fractures within that group laid bare, as Trump advisor Peter Navarro said there was a special place in hell for Canadian Prime Minister Justin Trudeau, and German Chancellor Angela Merkel famously photographed leaning on that table in a stare-down with an unmoved President Trump. The U.S. president then threatened Japanese Prime Minister Shinzo Abe, refused to sign a joint G7 agreement, and then he left the summit early for that now infamous meeting with Kim Jong-un in North Korea. That was something. And now you fast forward to 7 years later, and it might be deja vu all over again. The players are slightly different, but the acrimony is about the same, if not worse. And that is the backdrop for the next round of G7 talks, which ironically takes place in Canada, starting on June 15th. And yes, President Trump said he will attend.
I can hardly believe that that was 7 years ago. I'm not sure if it feels like less or it feels like longer. I'm still kind of trying to figure that out. But of course, the U.S.'s trade policy is going to be high on the agenda at G7. And here with more on all of this is Lanhee Chen. Lanhee is the David and Diane Steffi Fellow in American Public Policy Studies at the Hoover Institution and Director of Domestic Policy Studies in the Public Policy Program at Stanford University. Lanhee, always a pleasure.
Great to be with you.
Good to see you. So as Romaine showed us, Donald Trump puts himself at the center of all these trade negotiations, the tariff discussions. Right now, he's handed things off to Scott Bessent, the Treasury Secretary. And I wonder how you think about whether he will let Bessent do all the negotiating and come up with a number, or whether he's got to come in at the last minute.
Well, I think it's going to be a combination of both. First of all, Scott Bessent is clearly the ascendant figure right now in the administration on these talks. A lot of trust from the president. Great communicator. You see him out on Sunday shows talking about the president's agenda. So I think there will be a lot of delegation to Jamieson Greer, the U.S. trade rep, Secretary Lutnick, and of course Secretary Bessent. But President Trump's going to want to play a big role in this. He's going to be the one that comes in and eventually closes the deal. I think he sees himself as the closer, the one guy who can probably impose upon President Xi to reach certain agreements. I think it's important to recognize, though, that's not how the Chinese work. That's not how President Xi works. There has to be an orchestrated conversation that starts at lower levels, then mid-levels, and senior levels. That structure is very different from the one that President Trump likes. So we'll have to see how we cross those T's and dot those I's as we get closer to this next gathering, and then potentially when Trump and Xi get together later this year, maybe in the fall.
So I'm glad you bring that up, because President Trump also says that he's likely to speak with Xi Jinping this week. Is that the U.S.'s version of trying to push Xi into a conversation that he's not ready to have?
I think so. But, you know, look, the Chinese leader never comes to these conversations unprepared. I think he will recognize what President Trump is trying to do. I think the big question, of course, will be, is there something that President Xi can offer? Is there something that he, on his side, believes he can give up, so to speak, in this negotiation that will allow President Trump to say, look at what I was able to get, look at this short-term deal we have. I think we're locked into a cycle, Scarlett, of short-term deals until we do reach some of the more difficult structural questions, and that's going to take more time to resolve.
I know the big focus right now is on China and maybe to a lesser extent the EU, but what about some of the other nations? We haven't really talked at all. I can't remember last time we really had a meaningful conversation about Mexico, and who knows what the heck's going on with Canada, but Trump is going to be there in a couple of weeks. All the G7 leaders are going to be there, so there's an opportunity, at least for the G7 nations, to maybe hammer out something or at least to try to move talks along, right?
Well, I think that the Canada and Mexico conversation will take place in the context of the USMCA renegotiation. I think President Sheinbaum of Mexico has handled the negotiation pretty deftly so far. I think the Canada conversation will have a lot less friction now that Justin Trudeau is gone. I think Mark Carney is a much more, I think the president probably sees him as a straight shooter, someone who's a business guy, someone he can deal with. So I think that discussion will be much easier than it would have been with Trudeau. So I think Canada and Mexico are in progress. The ones I'm really looking at are Japan, Korea, and India. We always thought those would be the first three countries out of the chute. We got the UK. Now the question is, what's holding up Japan? What's holding up Korea? What's holding up India? India is going to be the toughest of the three. I think Japan and Korea relatively easier. But that's what we got to watch for.
Well, Korea's got some issues right now with their leadership that they've got to deal with. But Japan actually seems like that's a little bit more promising, at least based on what we've heard publicly from both sides.
I think so. And the resolution or apparent resolution of the Nippon Steel situation, I think helps to ease some of the background noise that was there. And look, I think the Japanese have made the calculation that in this U.S.-China overhang, they're going to edge a little closer to the United States. And that does make it easier for us to reach that agreement with the Japanese. And I think the interests are much more aligned there. That's why I'm much more hopeful about that negotiation.
How much do you think the U.S. dollar plays into the discussions with Japan, India, or Korea? Because there was some concern on the part of Taiwan that perhaps the White House wanted to ensure that Taiwan agreed to a stronger Taiwan currency in any kind of trade deal in order to make sure that U.S. exports saw a good reception in Taiwan.
Yeah, I think it's part of the discussion. You know, it's very difficult to see these broader trade deals being done without some currency context behind it. And we know how President Trump feels about the dollar. We know what his point of view is there. I have no doubt that some conversation there is going to be part of the scene setting around both of these deals, both Japan and Korea.
All right, speaking of deals, I want to get your thoughts really quickly on the bill that's making its way now through the Senate after it passed the House. Will this get done before the X date when the Treasury runs out of different options for the debt ceiling?
I have a little more confidence that we'll see that. I don't necessarily think July 4th is a reasonable deadline, given the fact that the Senate's a gauntlet. And let's not forget that the agreement that is in front of the Senate now that passed the House was very delicately negotiated. So if you try to take out any piece of that, let's say they try to take the SALT deduction and take that from 40 down to 30 or 25, that may not be satisfactory back to the swing state Republicans who have to vote for this in the House. So my sense is that the Senate is going to have a really tough slog for the next couple of weeks. I think they will get there eventually. But between now and then, you're going to hear a lot of reporting, a lot of news coming out of, we heard this person doesn't like this, Ron Johnson said this, Rand Paul said that. I think it's important to stay away from the noise and recognize that it is fundamentally in the interest of Republicans in the Senate to get something done and to get it done reasonably close to July 4th. I just don't have confidence it'll be done before July 4th.
Yeah, well, I'm curious, though, too, when we talk about the cooperation or maybe lack thereof, I mean, what does that mean for other bills? I mean, we were just talking about trade. I mean, ostensibly, these trade deals, in theory, are going to have to funnel through Congress at some point.
Yeah.
And I wonder if they can't even get, consensus right now on what they want to do with the budget. What does that mean for these big, beautiful deals that might come down the pipe?
I think they want to try and structure the deals to avoid congressional approval if they can, because as we've seen, as you said, in Congress, it is a slog. Now, the challenge, of course, now is that the president's use of the International Emergency Powers Act has been questioned by the courts. There's another question about whether they can do these deals legally in the context of this legal situation that's going on in the background. But I think avoiding Congress would be the goal, because once anything gets into Congress, it's game on in terms of potential changes and ways of boxing up the process.
All right. Lanhee, great to have you here in New York. I know it's far away from Stanford over there, out there on the West Coast, but we got some nice weather out here. Lanhee, Chen, David, and Diane Steffi, Fellow in American Public Policy Studies at the Hoover Institution and Director of Domestic Policy Studies over at Stanford University. We do want to continue this conversation on trade, specifically From the side of the EU, the potential for retaliatory tariffs from them, and of course, whatever tariffs we have here in the U.S. that could potentially actually block things here. The EU is warning that it could speed up that tariff retaliation on the U.S. with the next round of trade talks approaching. And that could present a big hurdle for small businesses with ties overseas. That includes a company like Belgian Boys. Now, it's based here in the U.S., Brooklyn, but it's a distributor of European-inspired breakfast foods and was named Instacart's #1 fastest-growing emerging brand last year. Will tariffs upset that? Anouck Gotlib joins us right now, the CEO of Belgian Boys, and she joins us right here on The Close. Anouck, great to have you here, and I love your products, and I love the progress that you've made in building this company. When you look at the tariffs that the U.S. has imposed, and more importantly, just the general disruption and uncertainty being caused with our supply chain, how have you adjusted, if at all?
First, thank you so much for having me. Really appreciate it. Very excited to be here and talk about our brand and how everything is, how we're on the back end navigating through those. You know, I think tariffs is just one of the business challenges that it's going through. We've navigated through many over the years as, you know, entrepreneurs. You start a business because if you have that passion, that drive, and what we aim to do is to bring that joy to the breakfast table, and we want to navigate all those challenges, including tariffs that are, you know, up or down, and our team is being really, really thoughtful about scenario planning and seeing how every scenario affects so that we can be agile and adapt according to what it will bring.
Are you already facing higher costs to import your goods?
I mean, there are higher costs regardless of the tariffs. I would say the egg market has been something as baked goods that right now eggs are on the way down. Shelled eggs are, but commercial dried eggs are not yet at those levels. So even without the tariffs, costs are up. And what we really want to remain for our consumer is remain attractive from a price perspective. And we're hoping to not have to increase the cost for our consumer.
The chocolate in all your products comes from the Belgian chocolate supplier Klaviyo, and I apologize if I can't pronounce that correctly. Have you looked into making alternate arrangements, perhaps getting your chocolate from somewhere else that's not in Europe, maybe sourcing it domestically?
So we have chocolate chips, bite-sized pancakes, and that's real Belgian chocolate that goes in it. We want to bring quality to our product. We have, though, moved some of our manufacturing domestically. We have done that at the beginning of 2024. And I would say that our company, with that shift, has been positioned in a way that we can easier adapt to everything going on right now.
What are your conversations with buyers at grocery chains like in terms of how much flexibility are they requiring from you? What are you able to do, and how are you able to respond as a result of their requests?
We're really being open, having those open dialogue, transparent, sharing that we're working on it with our partners, that we have plans to mitigate, and they're understanding, right? Like everyone is facing those question marks and those uncertainties, but just like any challenge, you just, I think entrepreneurs and small business owners are optimistic to default, and I think that optimism is really what stays grounded. My team has been excellent at the communication, the transparency, and I'm really looking forward to just moving through this as a hurdle, and we'll get out of all of this stronger. I know that.
What are you doing right now, Anouck, in terms of your long-term planning, in terms of growing this business? When we talk about small businesses, I know you have to deal with a lot of the day-to-day, week-to-week stuff, but I'm sure you also have an eye on what this business will look like 5, 10 years from now and beyond. Given the short-term issues right now, what is that outlook?
Well, we keep focused on our strategic plan. Our strategic plan has not changed. We are today in 12,000 stores nationwide, and we're growing our distribution, just bringing more breakfast to Americans nationwide by partnering up with new retail partners, getting into new channels, and we're just excited to have our product be more available in more retailers across the country.
All right, Anouck, really appreciate your joining us. Anouck Gotlib is CEO of Belgian Boys, and she is joining us from Brooklyn today. Waffles, so good.
Yeah.
This is, I mean, you are a big fan. You have this regularly, it sounds like.
Well, I don't have it regularly, but yeah, I mean, I enjoy a nice little waffle. And I mean, look, I just don't understand how these companies, though, continue, right? Because it's the idea that the costs are going up, and it's also the uncertainty, right? They might go up, how much? 10%? Maybe they go up 30%?
25, 30, yeah.
You don't know, so how are you modeling that in as a business? And I would just think that has to be very difficult for her to do right now.
Right, I really liked your question. I appreciated the question about what does this mean for your long-term plans, because you still have to make those plans regardless. And if you can't see 3 months, 6 months out, how can you see 6 years, 10 years out? Yeah. All right, let's take a look at how markets closed on the day.
Well, here's a big question. Are you a waffle person, pancake person, or French toast person?
Waffles.
Okay.
Belgian waffles all the way.
Why? Because it holds all the syrup?
Yeah, it's just good. I mean, pancakes I feel like are a waste of carbs, but waffles. To die for. All right, let's take a look at how markets closed on the day. Stocks did open under pressure because of the weak manufacturing data, but we closed at session highs. The S&P 500 adding 0.4%. What's been consistent throughout this, though, is a weak dollar. The U.S. dollar falling against all the G10 currencies. The Bloomberg Dollar Index now at its lowest in almost 2 years. Oil prices higher, so we often see those move against each other. And Romain, you highlighted this earlier. Yields higher across the curve, especially at the long end.
Yeah, absolutely. And this is going to be a big part of the story. We were talking earlier today about potential buyer strike that we're seeing on the long end of the curve. Of course, a lot of economic data and some big this week, and of course some big auctions next week. This is the close on Bloomberg. Media mogul Byron Allen is selling 28 of his local TV stations, hiring investment bank Moelis to help source buyers. The move comes as Allen looks to reduce debt and take advantage of potential deregulation in the broadcast business. Chris Palmieri joins us right now, who helps to lead our media and entertainment coverage out of Los Angeles. He spent a lot of years, Chris, building up this portfolio of TV stations. Why is he selling now?
Yeah, 6 years to be exact, spent over $1 billion. A couple of things. We've reported that the bonds, he owes almost over $1.5 billion in total debt. And it's been trading at a discount, which suggests investors don't think they're going to get paid. There was some of them organized last year, sort of committees to sort of protect themselves if there was a reorganization. On top of that, it was a very strong year for broadcasters last year because of the election, of record political spending. And a lot of excitement in the industry, as you mentioned, over potentially deregulation. And so for those reasons, he sees it as an opportunity to sort of sell and pay down debt.
Okay, so he's looking to sell 28 local TV stations. Where are these TV stations located, and how many does he have overall? Is this just a portion of his portfolio?
This is, and he won't necessarily sell them all. It depends on the offers, but they're in 20 different cities, all in the U.S. Honolulu, probably the biggest market. Tucson, Madison, Wisconsin, Tupelo, Mississippi. In some cases, he owns a couple of stations in each market. They're all affiliates of the big four networks. What the thought process is, if the FCC allows people to own, right now there's limits both nationally and in local markets how many stations they can own. If people can add more stations, they can save money, operating them together. So that's the play. That's been the play for a while, and there's potentially a lot of opportunity there.
Is there anything to read through into this potential sale about just the health of local stations? Because, I mean, he made a big bet, not only on this financially, but he, as you know, he was a big evangelist for this idea that local news, particularly when it comes to weather and things like that, that there was a huge market for that would stand the test of time, even as you saw the rest of sort of maybe the linear TV space kind of implode to a certain extent.
Yeah, that was the play, and it's certainly been true in terms of sports. Everybody's watching the big football games, basketball games, still on broadcast TV. It's been a lot more challenging on the entertainment side, and overall, there's just a feeling with everyone cutting cable TV subscriptions, and they're not really being able to replicate that audience online. That it's just going to be a challenging business for people that own local stations.
What is he looking to expand his investment on, his efforts on? I know that he was kind of a perennial name whenever we were talking about the bidding war for Paramount, his name was always mentioned, although it didn't get as far as the others. So I'm just curious what his long-term strategy is here.
Yeah, he definitely threw his name in the ring whenever a big deal came about. Look, he's really a remarkable guy. I think he got his start on The Tonight Show when he was 16 years old as a stand-up comedian. He produces over 70 TV shows. He's got one coming up in September on CBS in the 12:30 a.m. slot after Colbert. Comics Unleashed by Byron Allen. So just a really busy guy, a very unusual individual to be both a TV host and a business person like this. Still owns the Weather Channel, cable network. Is these digital channels aimed at all kinds of niche audiences, produces the shows. So he'll still have a substantial business, even if he sells all the local stations.
All right, good stuff. Chris Palmieri, thank you so much. Bloomberg's Chris Palmieri covering media companies for us there in Los Angeles. Still ahead on the close, we'll give you an idea of what to watch for over the next 24 hours. There are still more earnings, believe it or not. This is the close on Bloomberg.
All right, let's set you up for what the markets are going to have their eyes on over the next 24 hours, and that includes some earnings both here in the U.S. and in China.
Yeah, we've got EV maker NIO reporting. Of course, its ADRs trade in the United States. And Dollar General, another read on the low-income consumer. Earnings are expected to decline because they're dealing with higher promotional activity and also lower margins.
And kind of weird, too. You would think that if there is economic softness, consumer softness, that a company like that would benefit, but all the benefits seem to be flowing to Walmart. We're also going to focus in on the tech space with HPE CrowdStrike reporting after the bell tomorrow.
Yeah, and certainly we've seen CrowdStrike in the cybersecurity sector of tech become a real safe haven for a lot of investors.
Absolutely. And then about 5 a.m. Eastern time, we're going to actually go over to Europe where we're going to get some economic data.
Yeah, and I was looking at this. CPI set to slow to 2% year over year, and on a month-over-month basis, no inflation.
Well, that's good for us. So should they be starting cut rates then?
Well, they're not necessarily here.
Meanwhile, back here in the U.S., we are going to get a closer look at our economic situation, a drumbeat, of course, to the jobs data, but also a closer look at what's going on in U.S. factories.
Yeah, U.S. durable goods as well as factory orders, and both of them are seen falling for the month.
Yeah, and of course, we got that ISM data this morning, which seemed to suggest softness in that space. And of course, an update on the S&P PMIs as well. Of course, Team Surveillance will have full coverage of all of the economic data that comes out 8:30 a.m. Eastern time. And then Scarlett and I will be back tomorrow for all of your markets coverage. For all your political coverage, stick around. Balance of Power is up next.